Hey everyone, ZIM Integrated Shipping Company reported second quarter earnings results, which I'm going to review in this video. I'm also going to update my recommendation of ZIM stock. Coming into this report, I had the stock on the borderline between buy and hold. The stock is not expensive. It's traded down significantly off its high. So let's get right into it, and you're going to want to tune in to see if I'm changing that recommendation. Let's start with the earnings, however. Revenue for the second quarter was $1.3 billion, and that was a decrease of 62% year over year. Later on in the video, we'll find out why it's such a big decrease for this company. Net loss for the second quarter was $213 million. That was compared to a net profit of $1.3 billion the year before. Again, that's a result of decreasing revenue for the company, and here's why. The average freight rate in the second quarter was $1,193. That was a year over year decrease of 67%. You might recall last year and the year before, shipping costs absolutely exploded because people worldwide were spending more money on goods instead of services. And so there was a lot more goods being produced, and there was a lot more goods that needed to be shipped around the world. And that was great news for a company like ZIM. But the reverse is true now. People are interested in spending time and money away from home. They're not so interested in buying things anymore. And so the demand for inventory and things has decreased dramatically. In fact, companies like Walmart, Target, Home Depot, Nike have all said that they have way too much inventory on hand, and they've cut their orders of new inventory. So that's put pressure on a company like ZIM because consumer behavior has changed dramatically and companies are responding to that behavior, and so demand for shipping products has decreased. And that's just the short term difficulty that ZIM is facing. It also faces a longer term challenge as countries have moved on from the years and years of globalization where they were outsourcing and offshoring production of goods and then bringing them over because it was just so much cheaper for them to do that. Well, during the pandemic, they realized a lot of the risks of having their supply chains the way they have been. And so they've been nearshoring or onshoring has been the latest trend. And so longer term, that's also bad news for a company like ZIM. So in the second quarter, carried volume was 860,000 TEUs. That was actually a slight year over year increase. So the volume of shipments slightly increased year over year, but the price per shipment is still down dramatically for ZIM. So that's not been good news. Now, I also want to talk about the company's dividend and its dividend policy because I know a lot of investors began interest in ZIM because the dividend yield exploded when the stock price fell. But remember, let me refresh your memory about its dividend policy. So ZIM's dividend policy remains unchanged, according to which the company intends to distribute 30 to 50% of its annual net income as a dividend. So its policy is connected to net income. If net income increases, the dividend will increase. If net income decreases, the dividend will decrease. And so if investors are looking at ZIM for the dividend, unfortunately, the company reported a net loss for the second quarter. It was also a net loss for the first quarter. And so there is unlikely to be a dividend change for the better anytime soon because the company continues to expect losses to go forward. So if you're interested in this company for the dividend, understand and be patient and know that there will not likely be a dividend until this company turns around the losses on the bottom line, turns them into profits. Now, to update my recommendation of ZIM stock, I'm keeping it where I had it on the borderline between a buy and a hold. The stock is just so cheap, whether when you look at it at a price to free cash flow, and the stock was down 8.56%, after reporting these results, as some investors were hoping for better news on the bottom line or a better outlook for the rest of the year. Management disappointed investors on both fronts, reporting a net loss and suggesting those losses will continue for the rest of the year. Still, I think the stock is cheap enough here where you can get into it at a low risk price point, and if the company can manage to lower costs and decrease the number of vessels in operations. Now remember, the company is still positive cash flow from operations. It might be losing money on the bottom line, but it's still generating positive cash flow. So if the company can continue at this pace, boost its cash flow, slowly decrease the number of vessels it has in operation, and cut its cost and right size the business, I think it can be a nice solid company for investors at this price. Now, don't expect anything huge from this company. Don't expect revenue to grow by anything near double digits or anything like that, but just a low risk, low growth investment for long term investors. And eventually, it might return to paying that dividend as it becomes profitable again. So you could get a nice stream of passive income from this stock. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.